Picture a car so seductive that a fictional British spy made it the symbol of power for 60 years. A car that has won Le Mans, graced palace driveways, and appeared in every cultural fantasy of what success looks like. Now, picture that same company filing for bankruptcy. Not once, not twice, 7 times. That is the Aston Martin paradox. It is the most famous car brand in Britain. It is also one of the most financially broken companies in the entire history of global manufacturing. In 2025, Aston Martin posted a net loss of £493 million. They sold just 5,448 cars, down 10% from the year before. Their net debt has climbed to £1.4 billion, and in February 2026, they announced they're cutting 20% of their entire workforce, roughly 600 people, to try to stop the bleeding. The brand is worth billions. The business loses money like it has a hole in its floor. So here is the question nobody in the mainstream automotive press is willing to answer with a straight face. How does a company with the most powerful brand in luxury motoring keep running out of money? And more importantly, who keeps agreeing to bail it out? I have spent 26 years in business across Asia, watching capital flow in and out of prestige assets. And I can tell you, the Aston Martin story is not a car story. It is a story about the most expensive illusion in capitalism. To understand why Aston Martin is always broke, you need to understand one fundamental truth about the modern car business. You cannot build a competitive car company alone anymore. The numbers make this brutal. Developing a new car platform from scratch costs somewhere between $2 and $5 billion. Building the software systems to run it costs another billion. Certifying it for global safety regulations costs hundreds of millions more. And after all that, you need to keep updating it every 5 years just to stay relevant. Volkswagen Group spreads those costs across Audi, Porsche, Bentley, Lamborghini, and Skoda. Toyota spreads them across Lexus and Subaru. Even Ferrari, which everybody points to as the independent genius, is backed by the Agnelli family fortune through Exor, one of Europe's most powerful holding companies. Aston Martin has none of that. With roughly 5,400 cars sold per year, it is trying to cover the same engineering costs that Toyota covers across 10 million units. The fixed cost per car is catastrophic. Every single model they build needs to carry a development burden that would crush a mid-sized nation's infrastructure budget. This is why, since the very beginning of the modern car era, Aston Martin has needed a parent. The romance of British independence has always been a story told to the press, not to the accountants. Here is the comparison that haunts every Aston Martin boardroom meeting. Ferrari sold approximately 13,752 cars in 2024 and generated €6.7 billion in revenue. Their operating profit was €1.9 billion. That is an operating margin hovering around 28%. Aston Martin sold 5,448 cars in 2025 and generated £1.3 billion in revenue. Their operating loss was £259 million. Same luxury segment, same price points, opposite financial reality. The difference is not the cars, the difference is the business model. Ferrari understood decades ago that a car company with low volumes cannot survive on cars alone. So they turned Ferrari into a luxury goods brand that happens to make cars, the waitlists, the limited editions, the licensing empire, the experience events. Ferrari sells the dream of Ferrari as aggressively as it sells the vehicle. Aston Martin has the dream. James Bond gave them that for free. But they have never figured out how to monetize it beyond the car itself. They have the brand equity of Ferrari and the balance sheet of a startup, and every year the gap widens. Ferrari's stock trades at a premium multiple that makes it look more like Moet Hennessy Louis Vuitton than a car company. Aston Martin's stock has lost 88% of its value in the past 5 years. If you are watching this and thinking about how powerful a brand can be as a financial asset, and how a company can have all the prestige in the world and still hemorrhage cash, hit subscribe. Because we are just getting started. Aston Martin's rescue history reads like a list of the world's most optimistic investors. Ford Motor Company bought a controlling stake in 1987 and held it for 20 years. They poured hundreds of millions into the brand. They built Gaydon, They gave Aston Martin the resources to produce the DB7, the DB9 and the Vantage. Then they sold it in 2007 for $925 million to a consortium of private equity investors, because even Ford's deep pockets had limits. The private equity era was even messier. A rotating cast of investors, including the Kuwaiti investment Dar and Adim Investment, took turns owning pieces of the company while losses mounted. Investment Dar at one point faced its own insolvency crisis, making Aston Martin's largest shareholder effectively insolvent at the same time as Aston Martin itself. Then came the 2018 IPO, which was supposed to change everything. It changed everything, just not in the direction anyone hoped. The pattern here is important. Every new owner arrives with the same promise. They will cut costs, expand into new markets, and use the brand power to finally build a profitable business. And every single one of them eventually discovers the same problem. The math does not work. The brand is real. The business model is broken. When Aston Martin listed on the London Stock Exchange in October 2018, the opening price was £19 per share. The company was valued at £4.3 billion. The CEO at the time, Andy Palmer, described it as a turning point. A second century of British excellence funded by public markets. Within 2 years, the share price had collapsed to under £2. Not a correction. A collapse. The company's market value fell from £4.3 billion to barely £500 million. In percentage terms, it was one of the worst post-IPO performances by any major company in London. Stock exchange history. What happened? Almost everything at once. Sales targets were missed badly. Inventory piled up at dealerships. A planned SUV was still years away. The company had borrowed heavily to fund the IPO push and had no safety net when revenues underperformed. Then coronavirus arrived in early 2020 and removed any remaining margin for error. The IPO was not the beginning. It turned out to be a distress signal dressed in a tuxedo. By the end of 2019, Aston Martin was burning through cash so fast that desperate calls went out to potential investors. The Chinese giant Geely came close to a deal. Private equity showed limited interest. And then a Canadian billionaire with a taste for brand building and a Formula One team called. Lawrence Stroll is not a car person. He is a brand person. He made his fortune in fashion, backing brands including Michael Kors, Ralph Lauren and Tommy Hilfiger at exactly the right moments in their growth cycles. When he looked at Aston Martin in early 2020, he did not see a broken car company. He saw an underleveraged luxury asset with 107 years of history, and a James Bond contract that money could not buy. In January 2020, his investment vehicle, Tree Consortium, agreed to take an initial 16.7% stake for £182 million, with a broader capital raise of £500 million. By the time the deal closed in a market rattled by pandemic panic, Stroll had renegotiated upward to a 25% stake at a lower price per share, effectively acquiring more of the company for less money. He became executive chairman immediately. Andy Palmer was out within months. The entire strategic direction shifted. Stroll's plan was clear: reduce reliance on low-margin sports cars, build the DBX SUV as a volume driver, bring Aston Martin into Formula One as a marketing platform, and use the brand's luxury heritage to justify higher prices and more exclusive positioning. Since 2020, he has invested approximately £600 million of his own capital into the company. The question is whether willpower and fashion world instincts are enough to fix a problem this deep. The 2025 results suggest the answer is still no. In 2021, Lawrence Stroll rebranded his existing Formula One team, Racing Point, as Aston Martin. The rationale was straightforward. Formula One is the most watched motorsport on the planet. Having an Aston Martin car racing against Ferrari and Mercedes every other weekend is 23 races worth of global advertising that no media buy could replicate. The spending that followed was enormous. A new factory at Silverstone, a roster that included Fernando Alonso, a two-time world champion, and then the marquee signing, Adrian Newey, the most celebrated car designer in Formula One history, was lured from Red Bull in 2024. The F1 team itself reported a loss of $61 million in 2024 alone. Total losses since the rebranding have exceeded $250 million. On the track in 2025, results were underwhelming. The AMR 25 struggled through the season, rarely threatening the top constructors. The gamble now rests almost entirely on 2026, where a new Honda power unit and Newey's first full design with the team are expected to deliver a genuine step forward. It is a high-wire act. If Newey's car is competitive in 2026, the brand value narrative gets a massive boost. If it is not, Aston Martin will have spent several $100 million on a marketing campaign that delivered midfield finishes. Every analyst who covers Aston Martin points to the same historical lesson. When Porsche introduced the Cayenne in 2002, the purists were furious. A Porsche SUV felt like a betrayal of everything the brand stood for. But the Cayenne saved Porsche from insolvency and generated the profits that funded the development of every sports car that came after. Aston Martin's version of that bet is the DBX. Launched in 2020, it was the first SUV in the brand's 107-year history. The logic was identical to Porsche's. A vehicle priced at around £190,000 that could reach a buyer who wants the Aston Martin badge without the discomfort of a two-seat sports car. More buyers, more volume, better unit economics. The DBX has genuinely become Aston Martin's highest-selling model. In peak years, it has represented close to half of total sales. But here is the problem the Cayenne parallel obscures. Porsche was selling tens of thousands of Cayennes per year, building real scale. Aston Martin sold 5,448 total vehicles in 2025, DBX included. The Cayenne outsold the entire Aston Martin lineup by roughly 37-1 during 2024. The DBX is the right idea, but at these volumes, even the right idea cannot generate the cash flow needed to cover £1.4 billion of net debt. Here is what the press releases never quite say out loud. Aston Martin does not make its own engines for most of its cars. The V8 that powers the Vantage, the DB12 and the DBX comes from Mercedes-AMG in Affalterbach, Germany. The electrical architecture, the infotainment systems and the core technology foundation of Aston Martin's modern lineup all originated in Stuttgart. The partnership began in 2013. At the time, it was sold as a strategic alliance between two independent companies sharing resources. In practice, Aston Martin's CTO, Roberto Fedeli, has been quoted as saying simply, "Without Mercedes, we could be in trouble." That is not a partnership, that is a dependency. Mercedes-Benz holds approximately 9.7% of Aston Martin and supplies the engines that power the majority of the cars Aston Martin sells. Without that supply agreement, Aston Martin would need to develop its own V8 from scratch at a cost that would likely end the company immediately. The irony runs deep. A brand built on the romance of British craftsmanship and engineering independence is, at the core of its most important products, powered by German engineering it cannot afford to replace. Aston Martin knows this, Stroll knows this, and the attempts to develop an in-house V6 to reduce that dependency have quietly stalled as capital has run short. So where does this leave us in 2026? Aston Martin has a new CEO in Adrian Hallmark. It has a new Honda-powered F1 car designed by Adrian Newey. It has a new round of painful restructuring, 600 job cuts, a trimmed capital expenditure plan, and a target for profitability that has been pushed back more times than anyone in the City of London wants to count. But step back from the quarterly reports and ask the real question. Is Aston Martin ever going to be a normal, profitable car company? The honest answer is almost certainly not, and perhaps that was never really the point. What Aston Martin is, when you strip away all the financial engineering and rescue capital and Formula One politics, is the world's most prestigious trophy asset. It is a brand so powerful, so culturally embedded, so deeply tied to a particular fantasy of British excellence, that wealthy individuals and sovereign-backed investors will keep funding it indefinitely. Not because the numbers work, but because the alternative, letting Aston Martin die, is simply unthinkable to the people who have the money to prevent it. Geely now holds 17% of the company. Stroll still holds the largest stake. Mercedes holds nearly 10%. The ownership is a collage of global capital, keeping a dream alive through sheer force of will and disposable wealth. Aston Martin is too prestigious to die. James Bond guaranteed that. But it is too broken to truly live, and the most valuable thing it produces is not the DB12 or the Valhalla or the DBX. It is the feeling that owning a piece of it means something. That feeling, and the billionaires willing to pay for it, is the only business model that has ever actually worked. If you found this breakdown valuable, share it with someone who thinks a famous brand is the same thing as a healthy business. And check out our next video, because if Aston Martin is the most beautiful warning in capitalism, there are others out there that nobody's talking about yet.